Hello everyone, welcome to Tesla Daily News. Today is June 12, Thursday, and the following is the latest Tesla news. According to recent market data, Tesla's stock had a powerful session, opening around $388, dipping briefly toward $381, but rallying to close near $399, with intraday highs just above $399 and strong trading volume of about 45 million shares. That close is roughly 4.5% above the previous finish near $382. Signaling robust buying interest. In simple technical terms, uptrend intact, bulls firmly in control today. For traders and long-term investors alike, this kind of high-volume advance often reflects growing confidence in Tesla's future earnings power, especially as the market looks beyond short-term electric vehicle demand concerns toward Tesla's broader energy and autonomy story. According to Die Glocke in Germany, Elon Musk's space company SpaceX has now locked in what is said to be the largest initial public offering in history, and that has major implications for Tesla enthusiasts and Musk-focused investors. SpaceX confirmed the sale of roughly 555 million shares at an issue price of $135, raising around $75 billion and implying a stock market valuation of about $1.77 trillion. This immediately makes SpaceX worth more than Meta and, crucially for our audience, it pushes Elon Musk's paper net worth above the $1 trillion mark when you combine his holdings in SpaceX and Tesla. For Tesla investors, this matters in several ways. First, Musk's financial strength and access to capital increase his ability to support ambitious, long-duration projects across his ecosystem, from rockets and satellites to AI and electric vehicles. Second, a successful SpaceX trading debut reinforces the Musk premium narrative. Markets are willing to discount years of losses in exchange for exposure to his long-term visions. That same psychology has historically underpinned Tesla's valuation, especially during periods when profitability was still emerging. Finally, governance remains a key question. Die Glocke notes that Musk will retain more than 80% of the voting rights at SpaceX thanks to high vote shares. This cements his control over another mega-cap company and increases concentration risk for investors who are exposed to both Tesla and SpaceX, because strategic decisions at one company can directly or indirectly affect the other. According to Neue Vorarlberger Tageszeitung in Austria, additional details around the SpaceX IPO point to even more upside potential in the deal size and underline the scale of investor enthusiasm around Musk LED Ventures. The report explains that while SpaceX will issue about 555 million shares at $135, the underwriting banks also hold an option to buy up to roughly 83 million additional shares. If that option is exercised due to heavy demand, total proceeds from the IPO could rise from about $75 billion to as much as $86 billion. That would not just beat, but absolutely shatter, the previous global IPO record held by Saudi Aramco. Neue further notes that at this valuation SpaceX would immediately become the seventh most valuable listed company in the United States, overtaking giants like JP Morgan, Eli Lilly, and even Tesla itself in market capitalization. Musk is said to keep about 82% of the equity, preserving overwhelming control. In a move that echoes his strategy at Tesla, SpaceX has reserved roughly 30% of the IPO shares for retail investors, far above the typical allocation of under 10%. For Tesla enthusiasts, that broadens the Musk retail army phenomenon, where individual investors align strongly with Musk's long-term vision and are willing to stomach extreme volatility. Although some analysts voice skepticism about the $1.77 trillion valuation given SpaceX's current losses and relatively modest revenue compared to big tech peers, the market's willingness to support such a massive deal reinforces the idea that Musk-branded growth stories can attract capital on almost unprecedented terms, something that can influence sentiment toward Tesla during future funding cycles or strategic pivots. According to Nordkorea in Germany, a more detailed look at the SpaceX business highlights why many investors who already own Tesla stock are keenly interested in this new listing, even though it is a separate company. SpaceX generated under $19 billion in revenue last year and remains deeply loss-making, largely because of its heavy investments in the Starship rocket program and an aggressive push into artificial intelligence infrastructure through the XAI unit, which SpaceX recently absorbed. Despite that, the IPO values SpaceX at about 90 times last year's sales, far richer than the sales multiples at Nvidia or Apple. Nordkorea notes that SpaceX justifies this by pointing to an enormous potential total addressable market, roughly $1.6 trillion for satellite connectivity and more than $22 trillion for enterprise AI applications globally. The bulk of current revenue comes from Starlink, the satellite internet constellation that already counts around 10 million customers worldwide and has launched close to 10,000 satellites into orbit. For Tesla bulls, this is strategically important. Starlink's global internet infrastructure, combined with xAI's ambitious computing plans including speculative concepts like orbital data centers, deepens Musk's overall AI and data platform. That, in turn, could one day intersect with Tesla's autonomous driving, robotaxi, and energy management ambitions, which all rely on massive compute resources and connectivity. North Korea also emphasizes Elon Musk's personal brand as a critical factor. The larger-than-usual portion of the IPO, perhaps about a fifth of the shares, is geared toward retail demand, underlining that Musk continues to leverage a unique base of fan shareholders. The article suggests that index providers such as Nasdaq, FTSE Russell, and MSCI have adjusted their rules so that SpaceX can be added to some indices more quickly than usual, potentially accelerating institutional demand, a dynamic Tesla holders will recognize from Tesla's own index inclusion story. According to Finanzen.net in Switzerland, financial commentators are already speculating about a possible future combination of Tesla and SpaceX, or at least a tighter equity linkage, following the SpaceX mega IPO. The piece, titled Along the Lines of Whether Musk's Next Coup Could Be a Fusion of Tesla and SpaceX, argues that while such a move is far from guaranteed, investors should start weighing both the opportunities and the risks. On the opportunity side, a merger or partial integration could create a diversified Musk conglomerate covering electric vehicles, energy storage, launch services, satellite communications, and AI infrastructure under one stock. This could potentially simplify participation for retail investors who want broad exposure to Musk's entire vision without having to pick between Tesla and SpaceX. From a strategic standpoint, Finanzen.net notes that Tesla's expertise in high-volume manufacturing, batteries, and power electronics could complement SpaceX's aerospace and connectivity strengths. Shared AI workloads, joint development of specialized chips, and coordination of global energy and data networks are all theoretical synergies. However, the article cautions that there are serious downsides. Combining a relatively more mature and scrutinized automaker like Tesla, which is already in key indices and subject to automotive safety regulators, with a still loss-making aerospace and AI company could significantly increase financial volatility and regulatory complexity. Existing Tesla shareholders might be diluted or forced to shoulder SpaceX's heavy capital expenditure burdens. In addition, corporate governance questions around Musk's dominant voting control would likely intensify if he used that power to orchestrate a large related party transaction. For now, this remains speculation, but the market is clearly starting to price in the possibility that Tesla and SpaceX will collaborate even more closely, one way or another. According to the Motley Fool in the United States, the forthcoming SpaceX IPO has also reignited debate about index inclusion timelines, drawing comparisons to Tesla's long march into the S&P 500. The analysis explains that while SpaceX will debut with a market value near $1.77 trillion, making it one of the largest companies in America by capitalization, it will not automatically qualify for the S&P 500 in the near term. There are several obstacles. First, S&P Dow Jones requires that at least 10% of a company's shares be freely floated. SpaceX is only floating around 4% initially. Second, newly public stocks must trade for at least 12 months before they can even be considered. Most importantly, the index demands GAAP profitability in the most recent quarter and cumulatively over the past 4 quarters, conditions that SpaceX does not meet due to multi-billion-dollar losses from its AI and infrastructure investments. The Motley Fool recalls that Tesla itself went public back in 2000 but was only added to the S&P 500 in late 2020, after 4 consecutive profitable quarters and a lengthy review. That experience suggests that even if SpaceX grows rapidly, its path to index inclusion could be slow, especially if the company continues prioritizing growth over short-term profits, much as Tesla once did. By contrast, the article notes that the Nasdaq 100 has more flexible rules. Under changes implemented this year, a newly listed company that ranks among the top 40 constituents by market value can be included after just about 15 trading days. This means that funds tracking the Nasdaq 100 could become forced buyers of SpaceX stock within weeks of the IPO, creating a substantial secondary wave of demand. For Tesla enthusiasts, the takeaway is that Musk is once again steering a massive company through a familiar tension: pursue aggressive growth and technological leadership at the cost of near-term earnings, or slow investments to fit the mold of traditional index criteria. The piece concludes that SpaceX, like early Tesla, is clearly opting for growth. Investors who already own Tesla will recognize the pattern and must decide whether to embrace a parallel high-volatility story or maintain Tesla as their primary, more established Musk exposure. According to Clarin in Argentina, California Governor Gavin Newsom has announced a major new rebate program to accelerate the adoption of electric trucks and commercial vehicles in the state, a policy shift that could significantly benefit Tesla's heavy-duty division. The initiative, built around the California Clean Fuel Reward for medium and heavy-duty vehicles, will provide around $1 billion in incentives through the end of this decade. Authorized dealers across California will be able to offer upfront discounts ranging from $7,500 to $120,000 per vehicle, depending on size and application, for zero-emission trucks, delivery vans, semi-trailers, and other fleet vehicles. Clarin notes that this program directly aligns with the capabilities of the Tesla Semi, the fully electric truck that can travel up to about 500 miles on a single charge and is designed for high-efficiency freight operations. Because the rebates can be applied directly at the point of sale, they reduce the upfront cost barrier that has slowed fleet electrification. The article emphasizes that diesel trucks are among the biggest contributors to air pollution in communities close to ports and logistics centers, and that California is using revenues from its low-carbon fuel standard to fund these rebates. For Tesla, California's combination of the new program with its existing hybrid and zero-emission truck and bus voucher incentive project means a deeper pool of incentives for both freight and bus segments. In practical terms for investors, this signals a more supportive policy environment for Tesla's commercial vehicle and energy infrastructure businesses. The more fleets switch to electric trucks, the more demand there will be for fast charging networks, depot-level energy storage, and integrated software to manage charging and grid interactions, all areas where Tesla can participate, either directly via megapacks and related products or indirectly via partnerships. Clarin also highlights that in 2024, nearly 23% of new medium and heavy-duty fleet vehicles sold in California were already zero-emission, more than double the state's own target. That trajectory boosts the long-term thesis that heavy transport will follow passenger cars in electrifying, creating a second major growth leg for companies like Tesla. According to Derecho Diario in Argentina, the stationary battery business, an area where Tesla is currently dominant, is rapidly becoming one of the most attractive sectors in global energy markets, driven in large part by surging electricity demand from AI data centers. While electric vehicle sales in the United States have recently cooled, deployments of large-scale batteries for grid storage doubled over the past 2 years and show no signs of slowing down. The article reports that last year, about 57 gigawatt-hours of stationary storage capacity was installed, and Tesla accounted for roughly 82% of that total. Revenue from Tesla's energy generation and storage segment has doubled since 2023, thanks to products such as Megapack for utility-scale projects and Powerwall for homes, with operating margins around 30%, roughly twice the profitability of Tesla's vehicle business. Derecho Diario contrasts this with traditional automakers like General Motors, which typically earn around 11% margins on their core operations and are now hustling to catch up in storage. GM has just announced a new sodium-ion battery chemistry aimed specifically at stationary applications. Sodium-ion cells use cheaper and more abundant materials, do not require active cooling systems, and can tolerate more charge-discharge cycles than many lithium-ion designs, while also reducing dependence on supply chains dominated by China. But the technology is still in early stages, and GM does not expect mass deployment until later in the decade. In the meantime, Tesla's head start in manufacturing, project execution, and software integration gives it a substantial competitive edge. For Tesla shareholders, this story is crucial because it shows how the company is evolving beyond the cyclical auto market into a more stable and potentially higher margin infrastructure role. AI data centers, electrification of industry, and grid decarbonization all require huge amounts of flexible storage. As more companies, utilities, and even startups move into this space, the total market will expand, but Tesla's current share and profitability highlight its leadership. The article also points out that other players, including well-funded startups, are raising hundreds of millions or even billions of dollars for battery projects, underscoring that this is no longer a niche play but a central battleground of the energy transition. For investors, this supports the thesis that Tesla's long-term value will increasingly be tied to its energy and software platforms, not just vehicle unit sales. According to BT in Denmark, Tesla's push to roll out its advanced self-driving system in new markets has run into fresh scrutiny after a promotional video shot in Copenhagen showed a Tesla making a clear traffic mistake while driving itself. In the clip, which was shared by Tesla as part of its local marketing, the vehicle executes a right turn onto a road near the Tivoli area that is actually closed to car traffic and reserved exclusively for bicycles. The car reportedly passes a clearly visible no right turn sign, then an entry prohibited sign, and still proceeds to drive into the bike-only lane, even rolling over a large painted bicycle symbol on the pavement. BT quotes the political head of the Danish Motorists Association FDM, who calls the incident quite critical, noting that if the system can overlook such obvious signage, it raises broader concerns about how it handles more complex or dynamic hazards, such as pedestrians suddenly stepping into the road. At the same time, he acknowledges that, in theory, a well-designed autonomous system could ultimately outperform human drivers on safety metrics, provided that the human monitor inside the car remains attentive and ready to intervene instantly. Tesla declined to comment to the newspaper about the specific incident. For Tesla investors and enthusiasts, this serves as a reminder that while full self-driving is one of the company's most important long-term value drivers, especially for the robotaxi narrative, it is also one of the most heavily scrutinized and controversial aspects of the business. Missteps in new regulatory environments like Denmark can influence public opinion, invite regulatory investigations, or slow approvals in other European markets. At the same time, each new deployment generates more real-world data that can theoretically improve the system. The key investment question is whether Tesla can convert that data advantage into demonstrably safer behavior across a wide range of conditions faster than skepticism and regulatory friction build up. According to the News International in Pakistan, famed short seller Jim Chanos has publicly questioned the sky-high valuation of SpaceX ahead of its IPO, arguing that the deal is driven more by hoax and dreams than by fundamental financial metrics, a line of criticism that Tesla investors will find familiar. Chanos, who has a long history of shorting overvalued or structurally challenged companies, stated at a conference in New York that in his view SpaceX is not worth $1.75 trillion under any reasonable set of assumptions for the next several years. He points to aggressive operational targets, heavy capital spending on speculative projects such as data centers in space, and corporate governance concerns as reasons for caution. The article notes that many short sellers are hesitant to take large positions against Musk-related companies after witnessing massive losses in Tesla over the past decade, during which Tesla's stock rose more than 25-fold. Chanos argues that current market enthusiasm for data center infrastructure and AI-related stories may be extrapolating far into the future, and that many of these businesses resemble capital-intensive real estate or equipment providers rather than high-margin software companies. He also suggests that such firms often face depreciation pressure and limited pricing power because they buy advanced chips from suppliers like Nvidia and then lease capacity out to cloud providers. For Tesla followers, Chanos' critique matters less as a direct call on Tesla. He has criticized Tesla many times before, and more as a signal of the broader skepticism that can periodically hit Musk LED ventures when valuations appear disconnected from short-term cash flows. If sentiment were to turn sharply against ultra-long duration growth narratives, both SpaceX and Tesla could be exposed to multiple compression, even if their operating performance continued to improve. On the other hand, past experience shows that betting against Musk at scale has been extremely costly. As always, investors must balance the undeniable execution risks with the equally undeniable ability of Musk companies to redefine industries and command investor imagination. Thank you for listening to Tesla Daily News. If you enjoyed this episode, please subscribe and stay tuned for more updates.